Are going to talk about placing a value on a company or valuing a company. And we've basically come to the point where you should have reviewed financial condition or financial statements. You should have looked over the financial ratios. You should have looked over the video tutorial that talks about researching a stock as a business. And now we're at the point where we're going to use all of those factors to be able to choose a company to research further, and then we are going to place our own value on that particular company. A couple of things that we're going to look at with valuing a company. We're going to look at predictability of performance. We're going to look at earnings per share and the price earnings ratio, or the PE ratio. We're also going to look at your desired rate of return, which has nothing to do about the company. It has everything to do with you. And we will talk about that in the next couple of video tutorials. The other thing that I would like to add is that if any of this information is confusing to you, you do not understand it, then by all means please email me at omarbest@howtobeastockmarketplayer.com, or you can open up a ticket at the customer support link on the site. Please, if you are confused and you do not understand, email me. That's what I'm here for. The other thing I want to add is that I will be adding video tutorials on top of video tutorials that will show you examples of valuing a company. So do not get concerned or lose the faith, because I will be there with you every step of the way. Okay, so with that said, we're going to get into placing a value on a company, and we're going to talk about predictability of performance of a company. And before I go into performance of a company, we're going to break this down into a personal level. I'm going to break it down to a personal level. Okay, because believe it or not, you are very, very similar to a company. And as a matter of fact, you are a company. You are a business. Your product is your time and skill and your labor. That's your product. Okay, and you sell that on a daily basis to your employer. Your employer is buying your product, which is your time, labor, and skills. Okay, so in essence, you are a business. Okay, now when you want money, okay, you have to go to the bank. And what the bank does is the bank wants your last 3 paycheck stubs, or they may want your income tax returns for the past 2 years. And the reason why they want this information is because they want to know how much income that you will generate based on your past performance. Okay, and keep in mind that, say for instance, if you've been working for 8 years, you've had a steady job for 8 years, and your income is steadily increasing over the years, and then they take a look at your assets and your liabilities, and your assets totally outweigh your liabilities, then the bank is more comfortable with lending you money because they know that their investment is going to pay off. Okay, now on the other hand, if you've been in and out of work for the past 2 years, then the bank, number one, they won't be able to predict your future earnings because you haven't worked long enough. You're inconsistent, and therefore you are a financial risk. If your liabilities are higher than your assets, then they're going to be like, well, wait a minute, when we give you a loan, we're adding to your liabilities, and then you've been in and out of work for the past 2 years. So this is what the bank looks at. They look at your performance, or they look at you as a business before they actually invest in you. Okay? Alright, so predictability of the performance of a company. Alright? And what this basically involves is how the company has done over the past 5 years or more. Okay? And when you are evaluating the performance of a company, you are looking for trends. You're looking for, is the company's sales steadily increasing year after year? Or are the sales on a decline? Are they showing steady improvement in profit year after year? Are sales up and down? Okay, which means it's inconsistent. And there are a couple of other trends that you would probably want to look at. You would probably want to look at the return on investment over the years. You would probably look at the return on assets. You would probably look at their balance sheet and see where they are on their balance sheet. It's definitely a lot of factors that you can look at with predicting the performance of a company. But the main thing that you want to look at is if they're bringing in a profit and if they're consistently bringing in a profit. Another thing to note is that with a business startup or a new business, you cannot reasonably predict its future because it hasn't been in business long enough. And it makes it a higher financial risk. That's not to say that the business startup is not going to be successful. I'm just saying that you have no figures to analyze because the business is a startup. Okay, so that makes it a financial risk. Now, because it's a financial risk and because it's a startup, the stock price may be a little bit lower. And if you invest in that business from the start and it blows up 5 years later, then you're probably going to be looking at a major stock appreciation, and you're probably going to make a little bit of money. So I'm not saying stay away from business startups. I'm just letting you know that you cannot really predict the future of a business startup. So in essence, you will definitely be taking a risk by investing in startup companies or new companies. After you identify the trends, then you need to be able to quantify the increases or decreases. Okay, and like I'm using an example here with Starbucks. Starbucks has a steady increase in net profit over the last 5 years. And then what I want to do is I want to quantify the increases. I can't just say that their profit has been increasing every year since 1995. I need to be able to quantify it. So what I've done is that I've looked at how much the profit has increased on average over each year, and I've come up with an average increase of 5%. Okay, that could have been it could have increased 10% one year, 5% the next, 8%, 7%, or whatever. And I just added those numbers and got an average. Okay, so now what I can do is I can reasonably predict that the net profit for the next year will be at least a 5% increase, at least.